Look, this thing is expensively priced if you just look at it in PE terms. But when you have the kind of brand and pricing power that Ferrari has, you only need very little sales volume growth on top of price hikes and unveiling ever more expensive vehicles to continue growing revenues by double-digit percentages. The excess returns on capital and the incremental returns on their investments are as good as it gets. And so when you add in some operating leverage where sales and R&D costs decline as a percentage of revenue as the business expands, plus some buybacks shrinking the share count, that's how you compound earnings per share at nearly 19% a year for a decade. And really, I think they can continue compounding for years to come.
If there's just any chance you can get this company doing a sell-off where the PE multiple is modestly more reasonable, then I really do see this as a great chance to own as high quality of any company out there. Even in the world of high-end luxury, this is just a phenomenal business. We are off to the races today, folks. Both fans of Formula One and quality compounders should rejoice because we are covering none other than Ferrari, perhaps one of the most treasured brands in the world, and that status has translated into phenomenal financial results to an extent that is really unmatched by any other luxury vehicle brands. You might think Aston Martin, for example, comes with similar status as Ferrari, but their financial results pale in comparison. Shawn has had me really appreciate offline that there may in fact be something truly special about Ferrari. Listeners can decide for themselves whether they agree by the end of this episode, but either way, I think we are in for a great story. Hollywood has made a number of movies about this company for a reason. Anyways, before I ramble too much, how about I throw it over to you, Shawn, since it is your pitch after all. But just one last thing before I do so. In case you've missed some of our recent updates, I want to just quickly mention that we are going to be opening applications to our intrinsic value community of investors again soon. So if you're interested in potentially participating in a vetted group that discusses investment ideas weekly, you can just join the waitlist for updates at theinvestorspodcast.com/intrinsic value community. We'll also put the link in the show notes so you cannot miss it. But now I think it's time I throw it over to you, Shawn. Tell us about Ferrari.
Yeah, well, it's funny you mentioned the Hollywood movies on Ferrari because this past Friday I saw the F1 movie with Brad Pitt, and it was pretty good, not bad. But I had always heard that Ferrari was this very high quality company, and then I would look at the PE multiple and I would think, okay, well, I don't really care how good it is because I'm not going to pay 50 times earnings for a car maker. And then I would look at the stock chart and I would see these 20% plus annual returns over many years. And again, I would think, okay, this is probably just mostly from the valuation multiple expanding. And so those returns may not actually be based off the fundamentals and would just be more speculative instead. So I was really surprised to see that where the stock has compounded at 20% a year since 2020, earnings per share have compounded even faster with a 26% CAGR. So this is a premium stock. It's a premium price stock, but it is so for good reason.
Well, I'm sure you will help us understand whether that valuation for Ferrari is fair and at what price the stock becomes attractive to long-term shareholders who want to harness the power of this brand. And when speaking about a brand of that stature, I think we shouldn't waste the opportunity to talk some history here as well. So let's start at the beginning. What are the origins of Ferrari and what's the story behind this historical brand?
Ferrari was named after its founder, Enzo Ferrari, and it began as a racing team called Scuderia Ferrari in 1929. But instead of racing their own cars, they used Alfa Romeos. And then Enzo Ferrari would later establish his own company, Auto Avio Costruzioni, in 1939. And his first racing car, the 125S, debuted in 1947. And that was followed by the company's first road car, the 166 Enter, in 1948. And unsurprisingly, the brand quickly became synonymous with high-performance vehicles and its just iconic design. And as Enzo famously once said, Ferrari will always deliver one less car than the market demands. And that, to me, is the epitome of the true luxury mindset we talked a lot about with LVMH 2 months ago when I pitched that company. And like any luxury brand, the origins and the heritage matter a lot to the story. Enzo Ferrari, for what it's worth, has played the part very well for that. He had this truly fanatical devotion to his vehicles and especially the engines. There's another great quote where he says, "I don't sell cars, I sell engines. The cars I throw in for free since something has to hold the engines in." And some people even thought he cared more about the cars than the drivers in them at a time when fatalities in racing were unfortunately still pretty common. And so this was an obsession for him. Enzo had reportedly no other hobbies and never even took a vacation, apparently. He literally lived and breathed his work. And as such, he had his house built into the middle of a racetrack where he could live and test vehicles 24/7. So from dawn to dusk, really up until when he died, Enzo worked non-stop on Ferrari. And it was truly his life's work. And that ethic continues to power the brand and inspire customers all around the world. And flashing forward to today, and Ferrari sells about 14,000 cars a year, which is more than double the amount that former longtime CEO Luca Montezemolo had previously said the company should aim to sell in a year. So in just the last few years, Ferrari has really revved up production a bit, which always raises some concerns about brand dilution. But for context, Ferrari's vehicle sales hardly move the needle at all in the global automobile market. These are still very exclusive and hard to get.
I still remember from my Mercedes pitch that something like 90 million lightweight vehicles are sold every single year. So Ferrari makes up a very, very small percentage of those sales. And it looks even smaller when you compare it with other prestigious brands like BMW, for example, which sells around 2 million vehicles a year. And even Porsche sells only about 300,000 cars or so annually. So Ferrari is truly unique for how few vehicles it actually sells, especially relative to the size of the overall business, which is huge, as you will probably tell us. And even if you look at Rolex, for example, you might think they are a brand that can rival Ferrari's exclusivity, but in reality, it's not even close. Rolex sells something like 1 million watches a year, several orders of magnitude more than Ferrari's volume.
It is really crazy to think about that. This is a company with a $90 billion market cap, and they're selling a few thousand products a year. So to have a market cap, just shy of $100 billion and only have a few thousand units of volume, I mean, that would otherwise sound unfathomable if you didn't know that the starting price for a Ferrari is about $250,000 and more likely can easily reach $1 million or much more for these limited edition supercars that they sell. And as more context for you, I thought this was really interesting in my research. Volvo generates 6 times as much in revenue to earn approximately the same amount of operating profit as Ferrari. That is pricing power in a nutshell.
That sounds ridiculous. I mean, those steep prices are why they can boast margins of up to 50%, which is just unheard of in the automotive industry. I know how we discussed generally not wanting to invest in this industry because of just how bad the economics of it are when we talked about Mercedes, but Ferrari is just different. It's not even fair to list it in the same industry. I mean, Mercedes is one of the strongest brands in the world, and it still has no chance if you compare it against Ferrari.
Yeah, and if Mercedes doesn't have a chance, you look at Ford, for contrast, they have 8% gross margins. And General Motors is just a little bit better at 12%. And Tesla comes in with 17% gross margins, which is really ironic because some people legitimately treat Tesla as being a software company, and yet its margins are a fraction of Ferrari. So Ferrari looks like the software company. And even at Mercedes, gross margins are less than 20%. So with a 50% gross margin at Ferrari, I mean, that is just ridiculous. That's nothing in common with other automobile manufacturers. And so that is why in that episode on LVMH, I said Mercedes is more premium than true luxury, because true luxury margins are in a different league where premium is just premium to other automakers, but sort of in the same range as its peers. And Ferrari's margins are really in another universe entirely. And just to go back to the origin story, The next big chapter for Ferrari came in 1969 when Fiat acquired a 50% stake in the company. And that stake increased to 90% in 1988 after Enzo Ferrari's death. And then with the remaining 10%, that was held by his son, Piero Ferrari. And from there in 2016, Ferrari became an independent, publicly traded company following its separation from Fiat Chrysler. And then it did this joint listing where it went public on the New York Stock Exchange in 2015 under the ticker RACE, and then also added a listing on the Euronext Milan exchange. So Europeans and Americans should actually both find it relatively easy to trade the stock.
And the stock has been a great investment. Well, the stock has compounded at 27% a year since that IPO, making it effectively a 10-bagger in just about a decade. And that's, at least in my books, the definition of a high-quality compounder. But on another point, something that I also wanted to mention was that I'm sure we will reference LVMH a bit throughout this episode, since it's, our most recent luxury company, at least the one that we've covered here on the show. But really, the better comparison might be Hermes. Sergio Marchionne, as the former CEO of Fiat Chrysler and a major shareholder in Ferrari, aim to position Ferrari similarly to Hermes in terms of exclusivity and brand strategy. Like Hermes with its Birkin bags, Ferrari has long maintained an approach of controlled supply to sustain high demand and desirability. Just to even buy a Birkin bag, you sometimes have to make a series of smaller purchases to build your relationship with the Hermes brand. And then even if you get lucky, they will offer you the chance to buy a Birkin bag. And my understanding is that Ferrari does something similar, at least in terms of kind of pre-approving its customers. And that process alone just creates this incredible feeling of exclusivity, which only adds to the bragging rights of being able to say that not only can you afford to own a Ferrari or a Birkin bag, but the brand actually selected you to own one of, the very few limited products.
To me, the telltale of a masterfully constructed brand where supply is being effectively constrained to create exclusivity is whenever the secondhand price for a product is consistently higher than what the product normally would retail for brand new. And that is actually typically true for both Ferrari and Hermes. It's not uncommon for Ferraris to be more expensive on the resale market than they are when buying brand new, which is the total opposite of what we all normally know happens when you buy a car, right? I mean, you buy a car and 20% is usually lost to depreciation as soon as you drive it off the lot. And that is just not the case when we're talking about a true luxury brand like Ferrari.
I'm glad that you said the secondhand price for a product has to be consistently higher. Otherwise, Crocs would also qualify for being such a company. But the main difference between actual real luxury companies like Hermes and Ferrari, I would think, is that Hermes really doesn't even have to spend anything on R&D, whereas I'm sure Ferrari spends quite a significant chunk of its revenues on just consistently and constantly researching and testing how to build better cars or sponsoring its racing teams, for example. Without having gone super deep onto either company, that makes me inclined to say that Hermes might actually be the better business, even if both really have compelling economics in their favor. Although I would also add that the barriers to entry are arguably higher in Ferrari's case. I mean, both companies have huge moats, but the high R&D spend and also the Formula One experience make it significantly harder, at least I would think that, for a company to replace Ferrari compared to Hermes.
You're probably right, because Hermes's net income margins are about 7 percentage points higher than Ferrari, and its gross margins are 20 percentage points higher. So not having to spend 15 to 16% of your sales on R&D like Ferrari does, I mean, that makes a big difference to profitability. And Ferrari invests massively, of course, in research to stay on the cutting edge of performance. And if they didn't, the brand would deteriorate quickly. So it's a substantial but necessary cost. It's not something that they can just fade away over time to temporarily meet quarterly earnings targets. And so it's not surprising either that Hermes's PE multiple is even at a modest premium to Ferrari's. And again, both trade at very, very premium multiples of near 50 times earnings, because the market knows they have these truly enviable business models that are almost certainly going to continue being great. The earnings are very, very high quality. And I wouldn't say there's much risk of serious disruption for either brand because they're in a league of their own in terms of prestige and reputation within their niches. But one of the advantages that Ferrari does have relative to other luxury brands is its geographical diversification. They have relatively limited exposure to China. And if you contrast that with Richemont, LVMH, and Kering, which owns Gucci, they all have at least 20% of their sales sourced from China. And they have very much felt the pain as these Chinese consumers have pulled back on spending since the pandemic. And to your point of remaining on the cutting edge, I mean, much of Ferrari's R&D shows up through their F1 racing teams and vehicles, and they pour serious money into preserving their reputation as having the best performance vehicles in the world. And that means investing in F1 so that the brand can be associated with winning major races and all the publicity that comes with it.
I know a little bit about the interplay between Formula One and car brands through my Mercedes research. They've just released their new AMG prototype with phenomenal performance numbers and also a new battery technology that might be the most advanced out there. And of course, that also came from their Formula One team and research. So yeah, I'm curious to hear more about the interplay between Formula One and the different types of vehicles Ferrari sells. So maybe we can linger on that if you want to kind of help us better understand Ferrari's different revenue streams.
The core of the business, as you can imagine, is selling cars and spare parts. They produce and sell high-end luxury performance vehicles, is how I would put it, as well as the spare parts needed to service those vehicles. And then one of the most profitable parts of this business ends up being customizations. Some customers will pay enormous add-on prices to have their vehicle painted, colored, and otherwise styled to their exact preferences by specialized teams at Ferrari. And as I mentioned with the spare parts, Ferrari has an ecosystem devoted to maintenance and upgrades, as well as a program for restoring vintage models of Ferraris. And so all of that helps to round out the business beyond just making sales of new vehicles. And this is actually kind of crazy when I first came across it, but Ferrari actually has what you might call like this team of doctors that fly around the world to deal with special cases, and then they'll try and diagnose and treat the trickiest problems that Ferrari owners have. So that is as white glove as it gets in building a luxury brand.
Interesting. I think that's the kind of service you get when you pay $500,000 for a car. Correct me if I'm wrong, but I think that Ferrari has also been moving into the EV space. So now, selling or trying to sell electric vehicles soon.
Yeah. And like really every other automaker on earth for the last few years, they've been trying to figure out their EV strategy. So the short answer is yes. Their first hybrid actually came out back in 2013. And now hybrids make up about half their sales. I had no idea about that. And at the end of this year, Ferrari is supposed to unveil their first ever fully electric vehicle. So it will be really interesting to see how that's received by customers. And maybe I'm naive, but I would have thought the roaring engine was a big part of the experience of owning a Ferrari. And since these really aren't meant to be everyday cars that you might drive to the grocery store, I wouldn't have really thought that it would matter if they're being as environmentally friendly as possible. So that's just my intuition, but I could certainly be underestimating the amount of demand for EVs from Ferrari. It's probably a good way, though, to appeal to the next generation of ultra-rich customers who may or may not be more climate conscious than people in the past. And in terms of regulatory pressure to move toward EVs, which is one of the things pushing the broader automotive industry to try and address carbon emissions, the difference with Ferrari, just to hammer it in again, is that these aren't vehicles used for everyday transportation. No one commutes in a Ferrari. And if they do, it's a very, very small number of people we're talking about. With the point being, if the entire world were to truly move to hybrid and electric, I think cars like Ferraris could actually get some kind of carve out. And in fact, it may actually be less eco-friendly to make Ferraris electric, because with EVs, there's a very high upfront carbon cost that is paid to mine the minerals that go into the battery. And so EVs usually have to offset tens of thousands of miles of driving with a traditional internal combustion engine to have a positive net effect on carbon emissions. And like I said, if Ferraris aren't getting driven that much, you'd be building a car with a huge upfront carbon cost that may only be driven 2,000 miles a year and may not be able to offset that initial footprint for a very long time. And I wouldn't be surprised if truly long term, this all kind of ends up looking like the luxury watch industry. And so for context, when electric watches came out, they were the next big thing, and luxury watchmakers tried to follow suit because objectively, electric watches were more accurate and more reliable than mechanical ones. But eventually, the Rolexes and Patek Philippe's of the world switched back their focus to primarily mechanical because, as we've talked so much about in the world of luxury, luxury is not about functionality. You're paying for the story, the artisanal craftsmanship. And so if you're going to drop $100,000 on a watch, you want it to be unfathomably intricate. You want to know it was handcrafted. You probably don't just want an electric watch with diamonds or gold or whatever slapped onto it to make it more expensive. And I'm going on a tangent about this to say people may actually see gas-powered cars as the mechanical watches of the automotive world. And in 30 years, if we all own EVs, being able to buy a gas-powered Ferrari might only add to their exclusivity in status. And that is just total speculation, though. I really have no grounds to believe that'll be the case other than my own ideas about what could happen. It's so hard to find like-minded folks who speak the language of value investing. I know most of my friends and family are tired of hearing about my stock picks, so that's why we created the Intrinsic Value Community. It's a vetted private network for sophisticated long-term investors who care about deep research, sharing actionable investment ideas, and making meaningful connections. After a certain point, reading yet another value investing book only helps so much. Beyond actually getting my feet wet in picking investments, nothing has helped me more than getting feedback from a peer group of passionate investors who have supported my investing journey over time. From community debates about investment opportunities to calls with industry experts who share their unique strategies and insights with our members, it's a special group that I couldn't be more grateful to have been a part of. Spots in the community are limited though, and our latest cohort of 30 members filled up lightning fast, and our upcoming cohorts will probably be even smaller. If you want to take the next step as an investor, then go ahead and join the waitlist for our Intrinsic Value Community at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. What do you keep in your cupboards? If the last few years have taught us anything, it's that food shortages can happen fast. Empty shelves, inflation, supply chain failures, we've seen it all. I remember walking the nearly empty aisles of our local grocery store in 2020. It was a scary feeling that I'll never forget. As is true in investing too, it's best to be prepared, not surprised. Don't rely on grocery stores who always have what you need. A Harvest Right home freeze dryer can help you prepare for minor or serious food shortages. And with a freeze dryer, you can preserve your favorites. Freeze dry meals, snacks, fruits, and even ice cream, so your family always has real food, no matter what happens. The best part is it's affordable and easy to do, so stock up now while you can. It's a simple, affordable, and tasty way to secure your food supply for the future. With a Harvest Right freeze dryer, you're not just storing food, you're protecting your family. It's peace of mind. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. Hey guys, this is your host of the Intrinsic Value Podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout.
It's a good point, though. I even think that Ferrari is probably mostly going into EVs just to be safe from the regulatory breakdown that might happen in that industry. I would even add to that the vast majority of people who buy luxurious products just do it for the prestige itself. I think most people would probably not communicate that. And of course, there are exceptions, but that's what I see again and again. I mean, back in the day, you could argue to buy a Ferrari for the superior speed or acceleration. And today, if we're being honest, an EV minivan has similar acceleration to a Ferrari. So then people argue that they have no real engine sound, like you mentioned before. But I doubt people would actually go and criticize that when they buy a Ferrari EV. So again, there are exceptions. I have a friend who is really into cars and old timers and even spends weekends at exclusive car rallies where they drive old timers around. So of course, people like him care about more than just brand, but I don't think he's the average customer, even for Ferrari. But talking about races, how else would you say does Formula One factor into the picture here for Ferrari's business? I'm really keen to hear more about that. Whenever we get the chance to talk about sports and investing, I think we should take it.
Ferrari is synonymous with Formula One. I'm no diehard fan of F1, but even I do know that Ferrari is sort of like the New York Yankees of F1. They're by far the most successful team in the sport's history, and they're the only ones who have competed in every season since F1's inaugural race. And they essentially treat their spending on F1 as part of their marketing budget because they don't really do any traditional forms of paid advertising. And since most of their R&D budget goes toward supporting their F1 team, you can actually use their R&D as a proxy for their marketing spending in a way. And now, more recently, they've added really the Michael Jordan of F1 to their team in Lewis Hamilton. He is a 7-time world champion who just joined Ferrari this year. So it is really safe to say that Ferrari remains as dominant as ever in F1, and that is really important to their branding and culture. And Formula One's global popularity has also really surged in recent years. And a lot of that, at least my understanding, is driven primarily by Netflix's Drive to Survive series about the sport. And that has appealed a lot to younger audiences and actually a lot of my own friends, and really expanded the sport's female fan base too. And as a result, Ferrari's client base has kind of matched that trend and has now become much younger, with an average Ferrari purchaser now being less than 40 years old on average, and distinctly more female too, especially in Asia. So the rise of F1 has pretty tangibly translated into more real world sales for Ferrari. At basically every Grand Prix, the Ferrari logo takes center stage. So that has almost transformed the entire sport into one big ad for Ferrari. And then when you add to that the cultural cachet created by popular movies devoted to Ferrari's history, like the one that came out in 2023, it just feels like Ferrari is as famous and as relevant as maybe it has ever been.
The other thing that I've seen that Ferrari is going on are these lifestyle products that lean into the brand as opposed to actually being related to vehicles. So they sell clothing, perfume, and gadgets that are all Ferrari branded, and they even license the brand out to theme parks like Ferrari Land in Spain and museums. So they've created a number of bigger and smaller touch points to further perpetuate the brand's cultural relevance, even if Ferrari t-shirt sales do very little to directly boost the bottom line. And then there's something like 30 Ferrari stores worldwide, where each one is sort of like a temple to the brand. I've visited one in Milan once and it looked pretty cool. Although I must say, I always found it a bit weird seeing people walk around in Ferrari shirts that don't drive a Ferrari. So personally, I feel like it kind of dilutes the brand a little, and without a real benefit, as they don't make much money with it or need that, I don't know, form of extra promotion.
I felt similarly. I remember seeing the Ferrari store in Miami, but it is a pretty cool place. And at Ferrari's current scale, this kind of brand licensing, though, as you said, doesn't really move the needle a ton. But I do think it does amplify the company's reach. And what's been fascinating for me with this show has been with every company we study, for the most part, we get a better and better appreciation for how much branding matters. There's no single thing you can point to and say, okay, this captures everything you need to know about Ferrari. Like any brand, the Ferrari brand is a story. And truthfully, it is one of the best stories ever told. That's why there are so many movies about it and why it continues to captivate people's fantasies. When you have 18-year-olds across the country hanging Ferrari posters in their college dorm rooms, that tells you a lot about how the brand is perceived and will continue to be perceived by the next generation. And that's how I get very comfortable with the staying power of this brand. But you can also see this in the numbers too. They have an order backlog that extends well into 2026. And 80% of Ferrari's new vehicle sales last year were made to people who already own or have previously owned a Ferrari. And so just to say that again, because it's so absurd, 4/5 of their new sales are made to repeat customers. I have never seen anything like that before. And if you contrast that even with Lamborghini, only about 30% of their sales are to repeat customers. And so a couple weeks ago, we talked about Lululemon's industry-leading rates for repeat customers. But it's a totally different thing when half your repeat customers are spending $100 or $200 on apparel, and when your repeat customers are making $300,000, $400,000, or $500,000 vehicle purchases. So the customer loyalty at Ferrari is astounding, and that's why we use that word quality. I mean, that is quality. Ferrari ownership is a special club that so many want to be in, and once you're in it, by all evidence, people keep coming back.
It's interesting because sometimes you feel like you already know a brand or at least how big it is. But going through this episode right now, I just realized how big and important the Ferrari brand actually is, especially compared to all these competitors like Lamborghini, where you would think they're kind of on the same level, but apparently they're not. And something that's also interesting and we should talk about here, beyond vehicle sales, merch, parts, and customizations, is the financing division. This is a pretty common thing about automobile manufacturers, but there's a lending business built into the company, and that can sometimes, I would say, make the story even more complicated. For Ferrari, this division revenues seem to be far less consequential than for, I don't know, a company like Mercedes. But still, I would love to hear a bit more about it and whether it moves the needle, makes the investing case more complex, everything you know.
So Ferrari Financial Services helps facilitate the purchase of all types of Ferraris. So those currently in production, pre-owned vehicles, and classic models too. And then for those who have been proven Ferrari customers for some time, Ferrari will sometimes reward them with these special financing options. And it's just one more way for the brand to reward loyalty. In certain cases, with limited edition vehicles in particular, Ferrari will sell cars directly to customers, and the financial services division will help finance those purchases. But also, Ferrari sells its cars through 180 independent dealers worldwide. So Ferrari may also offer those dealers wholesale financing options, though they have actually started to phase that out in the last few years. And really, the vast majority of Ferrari's debt is actually just these lending liabilities. And to your point, Ferrari's nominal operating profit is about 1/6 of Mercedes. But Mercedes' net debt is 58 times bigger than Ferrari's. And so I say that to emphasize that even though Mercedes is a bigger business overall in terms of sales and also profits generated, its debt load is so much disproportionately larger because they have to rely on financing much more heavily to drive sales. With the difference being Ferrari's buyers are among the wealthiest people in the world, and financing might be offered for convenience purposes, but Ferrari buyers also don't necessarily need financing support in the same way that the average car buyer does. And in the US, for example, Ferrari's lending is spread across just 4,800 customers. And ultimately, these loans are backed by the value of Ferraris, which have very minimal depreciation, if any, and actually tend to appreciate over time. So the lending profile is totally different from making a loan to John Smith, who makes an average salary and wants to buy a Toyota Camry, which we know will depreciate dramatically with a few thousand miles of driving. Ferrari is lending to more creditworthy borrowers, and the loans are backed by higher quality assets. So I don't have a lot of concern about the lending division. And Ferrari, as we know, isn't playing a volume game either. And you need a volume game in lending typically for the business to be a profit center. So the financing business sort of just exists on the margins, and it makes up less than 2% of revenues.
When I look at the competition for Ferrari, it's interesting how much Ferrari stands out in the world of ultra luxury and supercars. VW, for example, owns Bentley, Bugatti, and Lamborghini, but the overall business is still just barely profitable. I mean, VW has 3% net income margins, while Ferrari has 23% net income margins. It's not a perfect comparison, of course, because VW mostly sells regular types of cars, but you would think that Bentley, Bugatti, and Lamborghini would help their margins a bit more. So Ferrari is special, but still, this is a stock trading at nearly 50 times earnings with a 90 billion plus market valuation. And Ferrari is as close to perfect as it gets, but ultimately, in my opinion, perfection doesn't exist. So buying a company priced for perfection always makes me a bit nervous. Aston Martin's market cap, for example, is about $1 billion or a bit less. And so my question is the Ferrari brand really 90 times better than the Aston Martin brand or worth 90 times more? It's kind of a simplistic framework, of course, but seriously, how can Ferrari be worth so much more than its peers, which also have luxury pricing, they are widely recognized brands, and they have rich histories of excellence?
There's this great video where Guy Spear talks about exactly this, and we can link to it in the show notes, but basically his argument is that Aston Martin and Ferrari may not actually be the same thing as much as you might think. And for example, subtle differences in branding can show up as a big difference in the business's economics. Ferrari customers are so fiercely loyal to the brand, they don't mind going to the edge of town to buy one. Whereas Bentley and Rolls-Royce have to pay for very expensive showrooms in the center of town to reach their target customers. And that results in much higher costs of distribution. And that's the difference between being able to truly pull your customers to you versus chasing after your customers. And I would not say that Ferrari is anything close to chasing its customer. If anything, it's doing the opposite. And as a result, Aston Martin is a business with negative operating profit margins, while, as we talked about earlier, Ferrari has almost software-like margins. So even if Ferrari and Aston Martin appear to be similar and selling very few but very expensive vehicles, again, Ferrari just is in a league of its own. And just looking at some of those other peers you mentioned, Ferrari sold nearly 14,000 vehicles at an average price of $570,000. Lamborghini sold 3,000 fewer vehicles, but it sold them at an average price of $340,000. And Bentley sold the same number as Lamborghini, but at an even lower average price, just below $300K. So clearly, the supply and demand dynamics are such that Ferrari can sell more vehicles and yet do so at a 70 to 90% average price premium to these great brands like Bentley and Lamborghini. And that shows exactly why I think there's something special about Ferrari and why the economics for them can be so superior.
Almost 600K is ridiculous. I would have guessed it's about 300 to 400K, but it really just shows that a lot of the sales are not the quote unquote average Ferrari, if something like that even exists, but special editions selling for these far higher prices. And how about, because that's so interesting, we kind of double click on Ferrari sales volumes and customer cohorts, and you tell us what does that look like and who is buying these cars? Who has that money to spend on a car?
You might be surprised to hear that total sales volume has nearly doubled over the last decade, but the number of vehicles sold per model per year on average has remained around 1,000. And the way they classify their customer base is into three groups: future Ferraristas, current Ferraristas, and collectors. And Ferraristas, for context, is the term people use to describe the most passionate enthusiasts of the Ferrari brand. And the first two categories only have access to Ferrari's higher volume range models, but may find themselves waiting up to 2 years to actually buy one. Clearly, Ferrari's intentions is always for demand to exceed supply. And then with the third group, collectors, well, they have access to or can be invited to purchase the rarer special edition and supercar models that Ferrari sells. So there is very much a customer hierarchy that exists, and I find that really fascinating. Just because you're super rich doesn't mean you're entitled to buy whatever Ferrari you want. And you can probably guess that turning down these types of people who are not used to hearing no personally or professionally, that only makes them want a Ferrari more. And having the broad portfolio of vehicles that Ferrari now has also supports repeat purchases by creating different Ferraris for different driving occasions. For context, Ferrari segments its customer base into people who are pilots, and those are people who are looking for a high performance extreme sports car for challenging roads, and then for sports car drivers who really want a more versatile luxury sports car driving experience. And they try to appeal to both with different models. And naturally, a big part of the moat here is the brand's intangible value. And I was actually surprised to learn this. But Ferrari has ranked as one of the strongest brands globally in 3 of the last 7 years, placing it among this really elite group of companies that consistently score AAA plus ratings from a third-party group called Brand Finance. And those other top brands include WeChat, Google, Coca-Cola, YouTube, Netflix, Rolex, Marina Bay Sands, and Deloitte. It is only one of 2 car brands to fall within the top 25 of those rankings, with Toyota being the other. So that is such a testament to Enzo Ferrari and the tradition that his successors have carried on in building one of the greatest brands really ever.
It is very impressive, though I know sometimes branding can be so abstract that people don't feel like it's really an actionable insight to have. What do you actually do with that information? I mean, there are so many different brands, so many different industries. It's kind of hard to categorize that. But where this does become more tangible, in my opinion, is the fact that selling Ferraris has been pretty easy historically, in the sense that they are typically sold new at a price below what the same car can sell for on the secondary market. And that's called residual value. And it's actually part of what many luxury companies do. Why that matters is because, well, it makes it easier to sell the new cars new, but also it creates goodwill with customers who can rationalize that they are actually making an investment instead of just spending their money, which implies that Ferrari is such a good brand, it pays to own a piece of it. I think you have some compelling stats for us on Ferrari's residual value, right?
I definitely do. I've been pretty excited for you to ask me that because, I mean, this is good. So a total of 74 cars have ever been sold for more than $10 million. And now I'll put you on the spot and ask you, how many of those do you think are Ferraris?
I mean, I feel like you're gonna say something crazy, like almost all of them. But when I think about all the ultra high-end brands out there and the different types of classic cars, I would think only a handful could be from Ferrari.
Your gut feeling was right. Ferrari makes up more than half of that list. So more than half of the most expensive cars ever sold are Ferraris. And
Wow.
if we zoom in on the top 10, Ferrari has 8 of the most expensive cars ever auctioned. So that is just absolute dominance. And while the decision to purchase a luxury item is driven by emotion and a symbol of status, the total cost of ownership is a consideration too, particularly among these long-standing collectors, where residual values increase, the cost of ownership is reduced. And as you said, that promotes customer loyalty in these repeat purchases. So now maybe it makes more sense how, unlike really any of their peers, Ferrari can have 80% of its sales coming from recurring customers. And there's this really cool index I came across, and it kind of looks like a stock index. It's called the K500 Classic Cars Index. And it monitors changes in the classic car market using tens of thousands of these verifiable auction sales results and then charting that index over time. And yeah, Ferraris of really any vintage do pretty well, and they tend to rise faster than the overall index on average. And while the index has actually quintupled since 1994. So that's a 5.5% CAGR over 30 years. And it's not bad. I mean, you would have been better off owning the S&P 500, but it is kind of crazy that just buying classic cars over 30 years might have done better than investments in bonds or holding cash in a high yield savings account. And according to Morningstar, and they cited a study by a car enthusiast group called Haggerty, they also confirmed that Ferraris generally fare better than their peers in terms of the rate of depreciation in a car's early years. And for example, when comparing Apex coupes, the value of a Ferrari 488 Pista rose approximately 5% 1 year after being sold and declined less than 10% 3 years after being sold. And McLaren 720S, on the other hand, loses around 12% of its value 1 year after being sold. And then by 3 years later, it's lost over 20% of its value. And a Lamborghini Aventador doesn't really fare any better either. It loses around 8% after 1 year and then 17% after 3 years of being sold. So I'm throwing a lot of numbers around, with the simple takeaway being that many Ferrari models don't depreciate within 12 months of being sold, which is uncommon in the industry. And they tend to depreciate less over several years than anyone else. And that was the study's findings in a nutshell. But there's just a lot of variance across make, model, and year. And this is going to sound like kind of a loony thing to say, but I actually see a similarity here with what Ferrari has cultivated among their customers and with Berkshire Hathaway. They've both created this culture of long-termism, and it reminds me a lot of the culture Buffett has created among shareholders of Berkshire, and we got to see that firsthand at this year's shareholder meeting in Omaha in May. And the types of people who invest in Berkshire and go out to the shareholder meeting, they're not your average retail investor. They are people who follow Buffett and have learned to think particularly long-term to an extent that is abnormal compared to the average investor. And not only is the average Ferrari purchaser not your typical car customer, they're not even really the typical car customer of other luxury vehicle brands. It's more like this cult-like following that deeply cherishes all things Ferrari. And that is what makes the brand unique.
You can really see that long-term culture at Berkshire literally in the fact that Berkshire's trading volume turns over much less than other S&P 500 companies. And with Ferrari, you see it in, as you mentioned, the higher rates of repeat customers and through vehicles that comparatively hold their value better than the rest. One thing I wanted to add, which will be pretty interesting to see, we will see how Berkshire's culture or how strong it actually is next year when we once again visit the shareholder meeting, and we will see how many people show up after it was now Buffett's last year at the meeting.
Right. And part of how they've done that is they've fostered this proud long-term ownership culture through offering a very comprehensive, long-tenured maintenance program. And in other words, there is a support system designed for every stage of a Ferrari's life. And that is pretty unique among luxury car brands. And for example, it is the only luxury car brand to offer a 7-year complete service plan, which is automatically included with every car purchase. And that sort of stuff implicitly conditions people to treasure their Ferraris beyond the fact that they spend a massive amount of money on them and to view them as these lifelong commitments in some cases. And that is fanaticism. And it's just not something you see with really many other products, let alone car brands. And after that 7th year, assuming your Ferrari is in excellent condition, which it should be, given the warranty program that's included, then your car will likely qualify for extended coverage through its 15th year. And that extension also applies to pre-owned cars and can be transferred between owners at any point during the plan. And between the 15th and 20th year of the vehicle's life, Ferrari offers specific maintenance kits over and above the regular service plan to then preserve car performance and safety systems longer term. And if customers follow those maintenance plans for 20 years, then their vehicle will automatically receive a certification that makes it more valuable to collectors ultimately. So there is an incentive to follow the guidance that Ferrari so thoughtfully lays out. And so when I say Ferrari has built a long-term ownership culture, sort of like the approach Berkshire has taken with its portfolio companies and shareholders, I'm not giving you a song and a dance. This is very real, and it pays dividends for the brands by making it easier to sell Ferraris at consistently high and rising prices over time. And that, again, is why they can sell 80% of new vehicles to repeat customers.
It's such a great system where even stuff like maintenance programs, which are usually just seen as a necessary service that is part of the product offering, but honestly just an extra cost for the car manufacturer, is turned into something that both increases retention and seriously adds to the culture of the brand and the lifetime value of a customer. I said it before, but your pitch today really gives me a new degree of appreciation for Ferrari. But at the same time, since we're considering making an investment, before we get too excited about the story, how about we linger a bit on the risks? What are some of the headwinds that Ferrari is facing?
Like all other auto manufacturers, it is in the process of dealing with what seems to be an irreversible trend. And as many people who came of driving age as teenagers back in the 70s, 80s, and 90s will know, preparing for and earning your driver's license was really a rite of passage. And it was typical that on your birthday, when you turn 16, the first thing you do is head to the DMV and get that glorious driver's test and secure an ID that really, in many ways, would authorize you to not just drive an automobile, but really gave you a sense of freedom. And yet, there has been a consistently growing percentage of young women and men between 16 and 25 who neither have a license, nor do they really seem like they want to get one that urgently. Since 1983, the percentage of 18-year-olds with a driver's license has fallen from 80% to 59%. I mean, I didn't even know that was going on, but that's astounding. And with driving services like Uber and Lyft really being ubiquitous in the US, even in these small cities, the number of drivers just continues to shrink relatively. And consequently, so does automobile ownership. So that is the real challenge. If the future is self-driving cars and maybe not even car ownership, because it's just so easy to jump into a nearby robotaxi, does that mean that no one will know how to drive 40 years from now? Would people have to learn how to drive just to own a Ferrari, or would Ferraris have to be self-driving? I mean, in that case, there's a concern that maybe car driving would kind of go the way of horseback riding. It was a skill that was very common, then it quickly became outdated, and now it's kind of stereotypically a hobby for the rich.
Wow, okay. I mean, that's a narrative. You can call me short sighted or naive, but that bear case seems like too much of a stretch to me. I mean, the underlying trend might be right. Fewer young people get driver's licenses, and with more and more AVs and ride sharing alternatives, not everybody needs a car. But when we talk about high performance cars, people just love to drive them. And it's that freedom that you talked about. And I'm not even yet talking about Ferrari, but more about Mercedes or BMW. And like we so often said today, Ferrari is on a whole nother level. But I guess you can argue that this might be a very distant risk weighing on the terminal value of the company. And clearly not yet. I mean, people are willing to pay a PE of 50, but perhaps in the future. And since we talk about terminal value often, it might make sense to explain what that even is. So what we mean by that is the value of a company beyond what we can model with some level of confidence in the valuation. I like to only model out 5 years. Some other investors choose to model out 10 years. And thinking about the terminal value kind of means thinking about what could threaten this business even after all that time. What could cause it to transition from a mature company to a declining one? And for Google, the anxiety is that AI chatbots or vertical search tools could kill its search and therefore also its high margin ad business. For a company like Uber, it's uncertainty around how AVs will change the mobility sector. Do we need an aggregator of demand in the future or not? Even with these two companies, I think those fears are overblown, but in Ferrari's case, I really don't see it at all. The first two are fears that we also already see materialize, at least to some extent. The Ferrari bear case is almost certainly decades away if that ever happens.
You're right. I mean, it's a really long-term bearish argument against Ferrari. And it maybe resonates with me a little bit. I do tend to generally think it could be directionally true, but people really overestimate, I would think, how quickly these society-wide changes like that can happen. And if we're talking about a risk that is, realistically speaking, 30, 40, or 50 years out, or is maybe just a complete sci-fi fantasy, then to your point in our terminal value, how seriously do we take that today? And the market doesn't seem to be taking it that seriously. And if the biggest argument against Ferrari's continued success is that the world will eventually run out of people who know how to drive, well, I'm pretty happy to take the other side of that bet for the foreseeable future. And maybe listeners think I'm making a straw man argument here because it really doesn't sound like a great argument, but I'm actually basically quoting an argument that was made by a few different professional investors on the Value Investors Club forum in a post a few years ago. And this gentleman in particular was making a case for shorting Ferrari. And the point being, this is a real consideration on Wall Street and for the bears. But if we were to own Ferrari, I would not be losing any sleep over this risk for the foreseeable future either. And as a more tangible risk, though, I would point out that the company, because of how sophisticated and unique Ferraris are, it does still rely on just a handful of these single source suppliers, where that supplier is really the only option and there's no backup plan. And the counter argument there is, well, they survived COVID and the disruptions from the invasion of Ukraine, but still there is a fragility there. Their supply chain is not going to be nearly as robust as other automobile manufacturers. And that poses some risks. And so fortunately, so far, Ferrari has not seen any significant changes in orders or cancellation following the implementation of import tariffs in the US. And plus, not only does Ferrari have pricing power, but tariffs could actually benefit them by boosting the residual value of Ferraris in the secondhand market. So that is kind of a wonky thing to think about. But it does kind of feel like no matter what happens, Ferrari wins.
It feels like luxury brands overall always find a way to win, even if tariffs can be good for the business. Something else that has stood out to me is that since its IPO in 2015, Ferrari has pursued something which you might call a horizontal growth strategy by offering the widest product portfolio among luxury supercar manufacturers. It seems that Ferrari has been able to increase total volume while maintaining its air of exclusivity. You mentioned this earlier when you talked about how total sales volumes have doubled and the average sales per vehicle model have stayed the same. How sustainable is it, though, for them to try and make more and more types of Ferraris so they can increase sales volume without diluting the status of any single model just by producing too much of it? It's hard for me to think that they could go another decade of that without throwing overall supply and demand for Ferraris out of balance.
I think the success of the strategy to broaden its portfolio is really only possible because of Ferrari's reputation for industry-leading innovation. Each model they launch has revealed some advance in design, technology, or performance, despite a rate of 15 model launches per every 4-year period, basically starting in 2018. So I wouldn't bet on their R&D budget falling too much as a percentage of sales because it just remains so structurally important to their growth strategy. And then you're right, they're testing the limits of how much they can meaningfully innovate. And there's a risk that those innovations go stale. And we've seen this with Apple. Launching a new iPhone every year or two has turned iPhone release days from these breaking news events that would promise to reimagine how we all use our phones and interact with the digital world to now being these sort of boring incremental improvements. I don't get that excited about them anymore. I mean, it hasn't been fatal to Apple yet, but I'm sure they wish they could command more hype from their launches. And it's just so hard to meaningfully innovate long-term at a certain pace. And so to your point, Ferrari could be setting itself up for something similar down the road. But the paradigm change for Ferrari has been from the very strong adoption of their hybrid vehicles. So that helped a lot to support volume growth over the last 5 years, since hybrids were truly something fundamentally different. And maybe the new types of EVs that they come out with can carry the torch and give them more room, more runway over the next couple of years to continue to excite people. But again, at some point, that it starts to go stale. The 6th different EV model is not quite as exciting as the first or second. That is just the reality. And And so more practically, things like personalization and collector car launches, I think will continue to drive the business forward longer term, though new releases will always be a big part of the sales strategy and the hype that they generate.
You mentioned this to me before we started recording, but I have to mention it because I found it so interesting. 40% of executives' long term incentives are based on total shareholder return relative to a peer group dominated by luxury firms whose business models also rely on branding and pricing power. And in my pitch for PayPal, I talked about how much I like the management incentives there, where management was judged against the total return of the S&P 500 over a multi-year period. And yet, Ferrari's comp structure might actually be a bit better than that. I love the idea of challenging them to really outcompete other top luxury brands that are publicly traded companies.
I agree. It is not a bad incentive structure at all. But it does puzzle me that they haven't done a better job of executing buybacks at more attractive prices. They've had this high class problem of always having such an expensive stock that it hurts their ability to do buybacks effectively. But maybe we talk about more when we get to the valuation section.
Let's just get right to it. I'm sure there's more to dwell on, but I'm curious to see where you landed with this stock and also talk about buybacks. So I'm ready to talk valuation if you are.
Okay. All right. Well, as I started working on my model, I couldn't help but think that the predictability of Ferrari's business is pretty compelling. They know pretty much exactly how many vehicles they're going to sell several years out into the future, because it basically increases by 1% to 2% a year. And then if they raise prices by an average of 5% each year, you've got baked in 6 to 7% top line growth. And it also helps that they have an order backlog with deposits that can span more than a year out into the future too. So again, you just have a lot of demand certainty, and maybe they can't raise prices by 5% a year for forever, but there is probably a pretty long runway for them to keep raising prices, especially with all the pent up demand from people just waiting to buy a Ferrari. I mean, what is the difference between spending $500,000 and $525,000 on a Ferrari to someone who maybe has a $50 million net worth? I mean, it's probably not a big one, especially if this is someone who is a true believer in the Ferrari brand.
For the long-term trend, it might bear mentioning that income equality has gotten way worse since the great financial crisis, meaning that in most places, the rich have gotten richer faster than the overall economy has grown. And the top 1% have done very well over the last 15 years. Just look at how the stock market has done over that time. So Ferrari buyers, I would guess, probably have as much disposable income, if not more, as they ever had. It certainly bodes well for their continued pricing power.
You're not wrong. And that is why I think Ferrari can continue to raise prices for many years to come, while also gradually pushing sales volumes higher too, as repeat customers make more purchases, and as the population of ultra wealthy people globally increases generally, that just creates many more possible customers for Ferrari. And I also think there is some operational leverage to be gained on what I would assume are these relatively fixed costs for R&D and administrative overhead. And for example here, since 2019, Ferrari has been investing $200 million more every year into R&D. Yet, R&D as a percentage of sales has fallen from 20% to 13% as the business has grown. So for anyone who's not familiar with this concept of operating leverage, that is a pretty good depiction of it. And it directly translates to higher profit margins. So that trend can continue as the business keeps growing, especially if that growth comes mainly from higher prices rather than trying to sell more vehicles and more types of vehicles, which would require an increase in R&D. So that price-driven growth is really the most valuable in some ways because it provides the most incremental boost to margins. And I could really honestly see Ferrari's operating margins rising to 30% or higher by 2029. And with the continued share buybacks that they've been doing, I don't see a reason why earnings per share couldn't easily compound at 10 to maybe 15% a year when you account for their top line growth, expansion in margins, and then this shrinking denominator from share repurchases that reduce the shares outstanding. And We look at a lot of companies. That's very healthy compounding, Daniel. And the question is, are we paying a reasonable multiple for that growth and the returns on capital that come with it? And so that's the trickier question. Since inception at IPO, the market has always treated Ferrari as not just a luxury stock, but really as being one of the best luxury stocks like Hérmes. And that's a credit to the investment bankers who originally helped sell the IPO. And it explains how Ferrari's multiple can be about twice LVMH's. Its median PE over the last decade is 40 times. And even over the last 5 years, its median has been even higher at 48 times earnings. And so today, the stock is trading near that 5-year median and actually toward the top of its longer term valuation range. So it would be hard for me to come here and argue that the stock looks relatively cheap. But given the quality of the earnings here, where you feel very confident that the company can endure recessions, continue to raise prices over time, and continue to use F1 and its brand to drive sales, on top of the very high returns on capital the company's historically generated, really relative to almost any other company, it's not surprising for Ferrari to have a much higher valuation multiple than the market average, but maybe not this high. I think a more reasonable price to earnings valuation for Ferrari would be in the low 30s. And so when I do some basic modeling and account for a pretty significant contraction in the exit multiple as the business continues to mature, I see the stock being fairly valued between, call it $300 and $320 per share, and pretty attractive to buy if you can get it at $270 or lower. And that is a substantial discount, I should say, to the current price at the time of recording of about $490. So even though I really want to own the company genuinely, it does have to be at the right price. And you know that. And right now we're not even close to it. So it's hard for me in good faith to say we got to add it today.
One thing that you can look at just to understand how expensive the company is looking at the dividends, which should be way more consequential than they are, since they spend a big chunk of their earnings on dividends. But actually, the price of the stock is so high that the dividend yield is like 0.7%. That doesn't move the needle at all, really. But at a lower entry price, that dividend yield would, of course, be much more meaningful.
It's a really good point. 27% of Ferrari's earnings go toward dividends, with another third toward CapEx, and then the rest goes toward share repurchases. Though the share repurchases, the same thing is true. They're also made at such a high price that it really doesn't have much of an effect on the overall share count. So I would actually probably prefer that they just distribute capital by way of dividends and try to more than double their dividend yield, make it a little more substantial, rather than just sinking a large chunk of earnings into these relatively unproductive share buybacks. And to put 40% of your earnings into buybacks that only shrink your share count by half a percentage point a year or so, I mean, that just really does nothing. And if you contrast that with our portfolio holding, Ulta, where they're allocating a higher percentage of earnings toward buybacks, for sure, yet they're shrinking the share count by 5 to 6% a year. So they're maybe spending 2.5 times as much on buybacks as a percentage of their net income, but they're shrinking their share count by 10 times as much. And that is the difference between buybacks at higher and lower valuations. And it just strikes me as very poor capital allocation by Ferrari, where they're treating share buybacks as this objectively good thing without considering the price they're done at. And whenever you're buying back stock well above the fair value for the shares, you're arguably destroying potential returns for shareholders going forward. So ironically, that poor return of capital strategy, to me, says to me that they should trade at a lower PE, which if that did ever meaningfully happen, would help them conduct more effective buybacks.
A premium valuation is a blessing and a curse in many ways. If you're relying on stock-based comp to attract talent or, want to use your stock as a currency to make acquisitions, then a premium valuation is great for managers. But if you're trying to maximize shareholder returns and return capital with share repurchases, paying a higher price tag reduces the number of shares you can actually retire for every dollar that goes toward buybacks. And in this case, Ferrari doesn't use stock-based comp all that much, and they don't make acquisitions in stock. So the really rich stock price isn't doing them any favors, honestly, in terms of buybacks and forward-looking returns for people who buy the stock today. And they destroy so much capital that it's hard to imagine where the growth should come from going forward.
I think that's a pretty long way for us to say operationally, Ferrari is great, but they really could further separate themselves by tweaking their buyback strategy. And with all of that said, I think it's safe to say we won't be adding Ferrari to the portfolio today, but it makes for one heck of a case study. Besides maybe the very first episode of this show, when I went through the pitch for Madison Square Garden Sports Company, this is arguably the coolest company I've covered. I knew learning about Ferrari would be fun, but I've really been pleasantly surprised at how genuinely high quality the business is and how enjoyable the case study was to do. It's a real masterclass on branding and in supply and demand too. So who knows, Daniel, maybe one day we'll go from debating buying the stock and we'll actually be buying Ferraris ourselves.
I would take that. I mean, unfortunately, we're at least 10 years late to finance that Ferrari by buying the stock in the company. Not to say that it's too late to make great returns on it or with it, but the risk reward has shifted. I think that's safe to say. If there's one mature company in the world where I would pay a PE of 50, it is Ferrari, just for how of an insanely well-run company it is. But I don't like buying stocks that are priced for perfection. And as your valuation shows, if we assume a lower multiple, and let's be honest, a P of 30 is still a premium multiple. The returns look really anything but promising. And as you said, another big problem with the valuation is just how inconsequential buybacks and dividends are at these prices. And if you just think about the billions of dollars they've already put into that, it's kind of sad to think about all that money which never really reinforced shareholder returns. And you know my bias for luxury companies and also strong brands. So if we should ever see it at a multiple around, the low to mid 30s, I would want to revisit it ASAP. But you know the company better than I do from what you told me today. And I do see no compelling bear case for this company. I think the only actual concern here is valuation and the multiple that you have to pay for it.
I agree. And I'm a little nervous about what it would take for the market to contract the multiple all the way down to 30. But as you said, if it's not something that's too much of a serious long-term concern, maybe it's just a general market sell-off and panic, that would be such a great opportunity to own what is an incredible business that really never goes on sale below 40 times earnings. So we're being a little picky here, but you have to give yourself that kind of margin of safety because the downside becomes way too asymmetrical at such a high PE like that. The company's just not growing that fast. If they're growing twice as fast than they currently are, I could maybe get behind a 40 plus PE, but just not the case.
Yeah. And perhaps we got lucky with the EV start. I mean, I could see a future where perhaps the EVs don't sell as good as the market hopes. And that's why, I think we only need 1 or 2 quarters, and a company that is valued at a PE of 50 might go down to a PE of 30. And that's just because, one EV comes out and it's not the biggest hit the market is expecting. And perhaps we then get a chance to grab the stock.
All right. Well, maybe EVs will be our big opportunity with Ferrari. Who knows? I think it's that time of the show where we move on to what's next. So how about we get a preview of next week's pitch? So care to give us a few hints, Daniel?
The company I will pitch next is one that has been around for a long time, at least if you compare it to the lifespan of the overall industry. And when I think about it, I recall my old school days because its products dominated the computer labs back in the day. And nowadays, the story is a bit less about hardware and more about clouds and AI. However, despite the AI narrative, it couldn't yet match the performance of any of those high flyers such as Nvidia. And that's why I think it might make a pretty interesting case right now. And I think these hints were pretty vague still, but I know we have some very intelligent people in our community, so I think that might be enough for some to get what company I'm talking about.
Okay, yeah. Well, with that, we'll leave you with one last quote from none other than Enzo Ferrari, who tells us, "I've yet to meet anyone quite so stubborn as myself and animated by this overpowering passion that leaves me no time for thought or anything else. I have, in fact, no interest in life outside racing cars." If only we could find that kind of passion from the founder of every company we look at. That would be great. I believe that spirit very much underpins Ferrari's continued success to this day as a company and with the stock. So with that, we will see you again back here next week for Daniel's pitch.
Like you said, Mercedes is like probably a company with like the best history that you can have, because I'm sure many iconic car makers have an interesting backstory to it, but only one can say that they invented the automobile. And Mercedes-Benz can. They are that one company. And that story goes back to 1886 when Carl Benz patented what's today widely considered the first gasoline-powered car. And it's called, and I will say it in German now because I have to play my home bias here, Benz Patent Motorwagen. The next two names I will drop are Daimler and Maybach. Both of them were German engineers, kind of at the same time as Carl Benz, but they invented their own engine separately from Carl Benz. And it was only about 40 years later that they merged those companies together. And then what you had was the Daimler Motorengesellschaft and Benz. And later on, that company turned into Mercedes-Benz, which is the company we're talking about today.